Predicting inflation has been particularly tricky for economists in recent years. In the aftermath of the financial crisis, we had double-digit unemployment rates and everyone expected deflation to come, but it never did. It was the dog that didn't bark. However, now, with oil prices falling, potential Chinese devaluation and slow wage growth, fears of deflation still persist. However, on the other hand, we do have core inflation at a 3-year high. However, it makes for a rather murky picture, and even Janet Yellen has expressed some humility about the Federal Reserve's ability to forecast inflation. There's a mix of factors coming together, which can send inflation significantly higher from here. In the US, we have an economy near full employment and core inflation already above 2%. However, monetary policy remains extremely loose, and fiscal deficits are set to rise from here on in. And as for oil, consensus forecasts for year-end are for oil prices to be back in the mid-40s, significantly higher from here. Put all of these factors together, and in 12 months' time, we could have a surprise from inflation, but a surprise on the high side, not on the low side. If inflation does break higher, taming it back is never painless. In fact, the rule of thumb is that if a policy isn't hurting, it isn't working. So even if central banks do understand the remedy for tackling high inflation, implementing it is not going to be easy. This time, with high levels of public and private debt and large central bank balance sheets, raising real interest rates will be particularly challenging. This leads us to believe that the death of inflation has been greatly exaggerated.